Do you know how to calculate your debt to income ratio? What is it and how important is it to buying a house? First off, my name is Ariane Lazo and I'm with Streamline Home Loans here in Las Vegas. I'm here to help you with info on your home buying experience. So let's get into it. If you're in the market to buy a house, your mortgage lender will look at a couple of main factors to determine if you qualify. Most people know that they will check your credit score and your credit history. They aren't aware of the debt to income ratio and how it works. What is a debt to income ratio? Your DTI is a comparison of your monthly debts to your gross monthly income or your income before taxes. The higher the percentages, the higher your risk of default becomes. Lenders like borrower with a DTI of 43% or less. This leaves plenty of money for living expenses and savings, reducing the risk of default. What's included in the debt to income ratio? The only information you need to calculate your DTI is your total debts and total income. Debts to include in your DTI. The debts you include are those of your credit report. A few examples include car payments, minimum credit card payments, personal loan payments, and student loans. The DTI also includes the new mortgage you're applying for, which includes the principal, interest, real estate taxes, and homeowner's insurance. It also includes any HOA dues and mortgage insurance if applicable. Income to include in your DTI. You can include any income the lender will use for qualifying purposes. Obviously, this includes your full-time income. But if you have any other sources of income that have a 2-year history and will continue for the foreseeable future, you may include that as well. Common examples include alimony or child support that you receive, or side gigs that you run with income that you can prove. Calculating your DTI. These two totals, you can calculate your own debt to income ratio using this calculation. Total debts over total income equals debt to income ratio. Here's an example. Jen makes $7,000 a month before taxes. Her debts include the following: minimum credit card payments of $150, car payments of $300, student loan payment of $250, and a new mortgage payment of $1,750. Jan's DTI ratio is $2,450 over $7,000, which equals 35%. How to lower your debt to income ratio. If your debt to income ratio is higher than a lender might like, here are a few ways to lower it. Pay your credit cards down or off. If you have any credit card debt, try to pay it off. If you can't, at least pay them down so your minimum payment drops and you lower your DTI. Pay down other debts. If you have other consumer debts, you can pay down to have less than 6 payments. Lenders may exclude them from your DTI. Increase your income. If your income is too low, take on a part-time job or start a side gig. You'll need to show receipt of income for a while, so the sooner you start, the better it is. Final thoughts? Your debt to income ratio is just as important as your credit score. Take the time to figure out your DTI and where you stand before thinking about buying a house. You can prepare both your credit score and debt ratio early on to increase your chances of loan approval. If you like this content, make sure you like, subscribe, share, follow me on social media, and contact me with any questions or any help that you may need on your loan needs. Until next time.